America's interest rate setting committee met last night, and after the meeting it was a game of two halves. The statement came first, and in it the Fed went from talking about when rates might go up to when they might go down, which is called shifting from a tightening bias to an easing bias. And then Chairman Jerome Powell held a press conference and was asked, "What about March?" And he replied, "Nah, sorry, unlikely." The US dollar jumped at that point, and on the share market, shoulders and prices slumped. So the Aussie dollar fell, and Australian share prices fell also for the first time in almost a fortnight. The banks that have been running hot had the biggest falls, while the lithium miners went down as well, as usual. But look, financial market punters might be gnashing what's left of their teeth, but this is good. The Federal Reserve has managed to get inflation under control without a recession and with barely an increase in unemployment at all. It's called immaculate disinflation. Markets and the Fed members themselves are forecasting much lower US interest rates, down from 5.25% to 3%. And that's good news for Aussie borrowers as well, because the Reserve Bank won't want to be a shag on a rock with a cash rate above 4% when that happens. And speaking of Aussie borrowers, as you've heard, the other side of the ledger, the asset side, is still rising, or at least the national median house price is, although it is getting patchy and the monthly growth rate is well into a decline, as you can see. And that's partly because the shortage is disappearing as the immigration comes down and housing completions rise a bit. And that's finance.